Hi, traders. How are you? Good afternoon to whoever's in that part of the world. Afternoon, morning, evening, wherever you are in the world. Welcome once again to another live Q&A session with Oliver Velez. Of course, my name is Oliver Velez, and as I always tell you, I am your trader for life, or at least I want to be. So come on in. Let's do this once again. Bring your questions, bring your comments, bring anything you'd like to discuss. As most of you know by now, those of you who are here with me weekly for these live Q&A sessions, you know that I try to take the vast majority of my questions from my Twitter feed. So I strongly encourage that you not only follow me there, but whenever you really want a question that you feel needs to be answered, that is the social media network that I am the most directly engaged with. Now, I'm engaged with all of my social media outlets, but I will tell you that that's the last remaining one where you are specifically dealing with me and not a team member, not a staff member, but me specifically. I don't know how long that's going to last, but right now it's small enough for me to really handle directly and solo. So, if you need to get in touch with me directly, if you really need a response from me, you should be following me on Twitter. Now, let me quickly show you. I want to show you what that is very quickly. Let me do that. All right, so I want to bring that up for you. And there you have it, traders. There you have it. So OL Velez 007. Make sure that there are no dots, there are no dashes, there's no funny business um with that handle, with that name. OL Velez 007, not OL Velez 007. Make sure that on my Twitter page you see 21,700 followers. Unfortunately, there are a lot of fake accounts that are posing themselves as me, not only on Twitter, but on Instagram and Facebook, and of course on YouTube. And so we live in this world where the onus is put on you traders. We live in this world where you have to be responsible enough to be extra careful. Make sure you dot all the I's, cross all the T's. Make sure that you are dealing with the accounts that you really want to deal with, right? I do not know what the solution is to all the fake accounts and the bots that are basically degrading the overall experience of social media and the ability for us to communicate in that medium. But I don't know what the solution is. But until we get a solution, the onus is put on you. I will never ask you to send me money. I will never ask you to send me your Bitcoin. Do you understand? I will never pop up in your DMs uninvited and ask you how you're doing. How's your trading? I will never tell you that I manage your money. I don't do that. Do you understand? So please, if any of those things are happening to you, it's not me. Now, it's your responsibility to be careful enough to make sure that you are dealing with me or dealing with one of my staff members. Okay? And one of the ways you can make absolutely sure is here. All right? Might take me a while to get back to you, but this is where I specifically respond to you at. Not a team member, not a staff member, me. All right. So let's dive right into it, guys. I do take my questions initially from my Twitter page. So I'm going to go directly there and start taking the questions. Okay. Now, of course, I'll take some from the feed here, but first I'm going to take from my Twitter page. All right. The first question I'm getting is from Jim, who's saying he's asking about what I call what I teach my traders as the Velez market laws. Now, the market is governed by certain types of specific laws, in my opinion. Um, there are specific laws that also must come from the trader. Another word for laws is rules. All right, but laws are slightly more important than rules because rules are made to be broken in certain well-defined scenarios. A rule is not applied 100% of the time. A rule is applied the majority of the time. A law is rarely broken, if at all. Okay? So that's the difference between a trading rule and a trading law. Now, there are market laws, but the most important laws, believe it or not, are the laws that traders set for themselves, not the rules. There's rules that traders set for themselves, and then there are laws like thou shalt not kill. All right, that is a law that basically 99.9% of the experiences or times in your life, that law should be abided by. Okay, so laws are more serious. I teach my traders a set of laws, 7 to be specific. Okay, so what Jim is asking is that, Oliver, the Velez market laws, would you please do an overview of the Velez market laws? Do an update concerning these laws. Thank you. Thank you for properly aligning whatever ignorance I do presently have. So, Jim, this is not the forum for me to go over all of the laws. That is a privilege for my traders. And of course, there are many people here who aren't my traders, but you're my followers. So we're going to split the baby here. I'm going to cover one of the most important market laws. It's not all of them, but I'll cover one that I believe is one of the most important laws. And I'm going to have to go to, shoot, I'm going to have to go to my overall screen here so that I can do this with you here. So let's just do this here. Okay. It's going to be a little bit sloppy, but I'll do it anyway. Okay. I'm hoping this works. Oh, boom. Okay. I'm hoping you can see my full screen here. I have basically it's a daily chart of Bitcoin right now, but that's not really what we want to focus on here. What I want to show you is this. I want to show you, I want to demonstrate what market law number 4 is. Now, there are 7 laws. We're going to cover market law number 4 to help you. And if I can quickly take a quick snapshot. Yes, boom, it's working. Okay, so market law number 4 states that if a stock, all right, if a stock has been, let's do it this way. If a stock has been, or an item has been making a series of lower highs. Now you see that low? That low is higher than the previous low. Okay? That's a lower low. All right? If a stock or your financial item has been making a series of lower lows, all right, sorry about that, lower lows, that's a lower low. And after a series of lower lows, there is a failure to make a lower low. Okay? See that? Boom. See that failure? That's the failure. That is market law number 4, which basically states that you have potentially found the end of that move. Okay? Now, the key elements here is that you must have a series first. This doesn't count with just really one. You need a series. So we've got 1 lower low, 2 lower lows, and 3 lower lows. You need a series. It works best when you have a series, when there's 3 or more. Okay? That's what I call a series. 3 or more, not 2 or 1, 3 or more. All right. And then market law number 4 is the failure to make a new low. Now, so there are 2 ways to get in on a potential turn once you have identified a market law number 4 bottom. The conservative way is to wait for there to first be a new high. So a new high. All right. That's what this is the conservative way to get in. And then you buy the next pullback as long as the next pullback does not make a new low. So next pullback, and boom, your event, whatever event you're buying, all right, my traders know the 7 events that they should be buying. They're going to buy there with the idea of this being the turn. Okay? So that's the conservative way to get in on a market for reversal. The aggressive way is to do this. Lower low, that's 1. Lower low, that's 2. Lower low, that's 3. All right? A series is 3 or more. All right? Here's your failure to make a new low. That's your market law number 4 bottom. Now, the aggressive buy is to buy the event that confirms the failure to make a new low. All right? Whatever event, my traders have 7 events that they play. That's all. Any one of these 7 events that occurs right there, that event is essentially confirming that there will be no new low. All right? Tight stop under that event, and the conservative buy can be that trader's add, not that trader's initial entry. And so the more aggressive market for trader is buying right off the low. The conservative market law for trader is buying the confirmation low, because this is the confirmation low. And the aggressive trader can decide to use the confirmation low as their add opportunity, and the more conservative market for trader is using the confirmation low as their initial entry. And so out of the 7 market laws, that is by far one of the most important of the laws. All right? And so, guys, just to give you an idea of what I teach my traders, we teach our traders these laws. We teach our traders 7 events. We teach our traders 7 locations. So it's 777, 7 market laws, 7 events to play based on these laws, 7 events to play based on these laws at one of the 7 positions or locations. Now, location is an extraordinarily important part of trading. In fact, location is one of the most important parts of trading, and the vast majority of market players out there are not using the concept of location. Location is very similar to anything in life. You've heard of someone saying, he was in the right place at the right time. That's location, right? Location is very important in life, not only just in trading, in general life. He was in the right location at the right time. All right? Location, right? What's the odds of someone getting struck by lightning in the wrong location? Location is important, right? Real estate. There are 3 ways in real estate to make a lot of money: location, location, location. All right? And the same applies in the market as it does in life, as it does in the real estate market. Location of your event is very important. As an example, the location of this topping tail bar and that color change reversal right at the 200 is important. The location of this color reversal, which my traders know as a bear 180 right at the declining 20, is important. The location of this powerful bottoming tail bar this far from the 20-period moving average is a very key location. And so when you start to combine the market laws with the market events, and you combine those things in the right location, the only thing left is protection and trade management, protection and trade management, protection for when the play doesn't work, trade management for as the trade is working, how do I manage the working trade? And so that's it, guys. It's market laws, market events combined with those market laws, the market events with those market laws at the right locations. Once you do that, protect yourself just in case it doesn't work. And if it starts working, manage it properly. And there's nothing else to trading. Now, you have to fill those categories in with some very interesting details. And that's what I help my traders do. All right. So I hope that helps. That is question number one. Boom. All right. Let me see these things here. All right. Let's go. Question number two. Let me get here. Uh, Speaking of locations, Imran Khan is asking, hi, boss, what are the best positions or scenarios where we can enter our anticipatory plays without having to confirm plays? So, what Imran is asking, he's saying, look, we have specific guidelines for anticipating something in advance and doing something after it has been confirmed. So there are two ways we enter opportunities: to anticipate what is about to happen, or to get in once something significant has been confirmed. Okay? Now, the general idea, all right? Did I go live in the wrong place? This is what I'm being told, that I went live in the wrong place. I can change this. We can start all over again. I will start all over again. What should I do? Talk to me. Should I start all over again in the right place? I will do the whole thing again. I don't care. What should I do? What should I do? Talk to me. 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 All right, let me see. I went wrong in the wrong place, guys. I am so sorry. We can start this again. Should I go live in the right place now? Or should I continue? Okay, good, good. Thanks. Thanks. All right, guys. I'm so sorry about that. I went wrong. I went live in the wrong location. Oh my God. How was that? Hmm. So sorry. So sorry. All right, guys. Once we finish this, we're gonna have to change the image, and we're also gonna have to change the title of this because it's not what's posted here, of course. All right, guys. Sorry about that. My mistake. My mistake. I'm good. Okay. All right, guys. So look, this question here. All right. This question about when do I know when it's time to do an anticipatory entry, or when do I know when do when is it more appropriate to wait for something firm to happen and then get in after the confirmation of that firm thing? I think this is what the question is. And the person also asked, Imran also asked, I know the anticipatory moves have lower risks, but also lower probability for success. So I often get this. There is this, there's this natural tendency to believe that if I wait for confirmation, it's safer. If I anticipate, it's not as safe, it's riskier. And this is wrong. Statistically speaking, anticipating an event is actually safer than waiting for the event to occur and then getting in after you're confirmed that the event is what the event is. Typically, because statistically, you will be getting in before a partial movement in your desired direction. Because normally, when you are entering from a confirmation point of view, you're waiting for it to confirm your directional bias. You're waiting for it to confirm a little bit that you're right. And then after it's showing you that you're right, then you're getting in. So that's a little bit later. Statistically speaking, when you anticipate, you're getting in before the item moves in your favor. Now, why is that statistically safer? Because you are closer to the point at which you consider yourself wrong. You're closer to your stop. Now, so you lose less on anticipation plays on average, not all the time, but on average, you lose less, okay? You lose less than you would typically lose on confirmation. Okay. So anticipatory entries are statistically safer from a dollar perspective, from a loss perspective, from a risk perspective than confirmation. So that's the first thing. Um, so this person's asking, in particular, tail bars, like how do I anticipate a tail bar? So I'm gonna have to take you to charts again, if I can, and I'll show you. All right. So what we're gonna do is we're gonna go here. Boom. I go back. I don't know why it does that, but we'll go back here. Boom. Okay. So this is a perfect example. Today, a number of my traders took this play, and it's on a stock called Pfizer. I'm sure many of you are familiar with that, given the last 2 years. And the first thing I'm going to do with Pfizer here, which is a 2-minute chart of Pfizer here this morning, is I'm going to mark off what my traders know as basically the Fat Four. All right, I'm going to mark this off. Let's just do this here. Okay. Now, I want you to take a look at bar number 1. This is bar number 1. Now, if you look at the complete bar number 1, you see that underneath the color green was a bottoming tail bar. Now, what I believe is important to understand here, traders, is that the tail occurred first before the green occurred. So there was really no green first. Okay. The first thing that occurred was this. Take a look. Let me show you. We opened here. That's the first transaction of the morning. And then Pfizer dropped, creating a red bar. Boom. Now, relatively quickly, the red starts to eat itself. There's less red. So let me just do it this way. I think this might be an easier way for me to do it for you. I just do a straight line down, right? Boom. Okay. So that is what we have first, a red line, a red bar. That's a thick red bar. The same way you see thickness on the green side to the upside, at first there was thickness on the red side, but this red starts to eat itself. Less red, all right? Less red, half red, 1/4 red left. Boom, no red. Now here is where my advanced traders, right, would be entering on the elimination of red. That's the anticipation play. It is the elimination of the red. Now, after the fact, you don't see the color red, but the color red is hiding from you. Do you understand? The color red was there, and then the color red began to eat itself. 3/4 red, half red, 1/4 red. Boom, no color red. Boom. We play when one color aggressively eliminates the opposing color, just like a sporting event, right? We're betting on the color green because green has demonstrated, the green team has demonstrated its ability to push the red all the way back and then to continue pushing them up, 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 up. So the true best entry on this is here, on the elimination of red that happened right before your eyes watching this at the open. All right. And it happened at a fairly nice location as well. All right. And so that's how you predominantly anticipate on a tail bar. Let me show you. So we see where the anticipation entry on a tail bar is there at the elimination of the color. But the confirmation is here. You see how late the confirmation is? So this is anticipation entry. This is confirmation entry. Which do you think is safer? Of course, anticipation entry. You're getting in the elevator at a much higher floor, which means that if the elevator drops back to floor 1 or 0, the basement, you're going to be hurt further from C than you will A. Do you understand? And so this is a perfect example to show you not only how to anticipate tail bars, but it also shows you clearly that statistically anticipation entries are safer than confirmation entries. Now, you have to just be careful of one very important thing. You can anticipate too early off the open in particular. I don't want you anticipating in the first 2, 3, 4, 5, 6 seconds. That's too early. All right. That's the only caveat. So I hope that helps, guys. Boom. Yes. Question number 2. In the bag, in the bag, in the bag, baby. Question number 2 in the bag. All right. I like it. Let's go. Could you please talk about Bitcoin? I thought you'd never ask. Of course, I can always talk about Bitcoin, my favorite topic these days. All right, so guys, look, I believe that, as I mentioned to you, I believe last time, I believe that, first of all, I will tell you that I've never seen an asymmetric bet in my entire 40-year career, 36, 30, almost 37 years professional career, but 40 years of playing the markets, 40 plus years actually. I've never seen an asymmetric bet like this. And I've had some really major life changing bets in this game: Microsoft, Apple, Amazon, gold, Tesla, Nvidia, Facebook. The list goes on. My traders can tell you this. Okay. Those of you who've been following me over the last several decades, they can tell you this. Many of whom got very wealthy following some of these very same plays. But I will tell you this: I've never come across a bet that is so asymmetric in my life, and I have never been so bullish on something ever in my entire life. I am not talking about bullish over the next day, the next week, or even the next month. I'm talking about bullish over the next 4 years, 5 years, 10 years, 20 years, 30 years. And Bitcoin is an asset that I believe is here to stay. It has reached that precipice where it cannot be killed, it cannot be halted, it cannot be hacked, it cannot be banned by anyone on planet Earth. It is a permanent fixture. I believe, very, very much like many others, that it will become the seventh sector of the entire market. We now have 6 sectors. It'll become the seventh sector of the entire market. I believe it's here to take over um, uh, the role that gold played for the last 5,000 years and silver played for 9,000 years. So silver was the first role, gold was the second role, okay? And Bitcoin has come to receive the baton from gold. And so gold received the baton from silver, all right, and lasted for 5,000 years. It is now broken. It is now tired. Gold is the senior citizen of this sector. All right. It has long been time for gold to pass the baton to something better, something more secure, something that's more appropriate for the digital age, and that is Bitcoin. So if you were to go back to where gold began to falter, that is at the birth of Bitcoin. Let me just show you this, okay, so that you understand this. All right. This is very, very important to understand. Let me get this for you, and you'll understand what I'm talking about here, okay? Boom. Okay, we'll go back to Bitcoin. There we go. So let's take a look at this. I want to go back to, want to make sure that I have that Bitstamp. I need Bitfinex. Maybe Bitfinex has it. Go back to, Bitfinex has the entire history. No. Okay. We're going to go to, I need, yeah, here we go. Okay. So, guys, keep in mind that Bitcoin came into existence in January of 2009, but it literally had zero price until 2011. Now, take a look here. Take a look at 2011 right here. Okay. Boom. 2011, it gained its first price. From 2011, it's literally been a straight line up for 13 years. Okay. Well, for 11 years in this case, because it had zero price during its initial birth years. All right, so it's been literally basically a straight line up for 13 years. Now, take a look at this. Gold, all right. Let's take a look at gold here. Gold has been with us for 5,000 years, and it has literally been going up for 5,000 years. All right. This was gold's all time new high. Guess what year? Look at the year. I'm going to point to the year 2011. Why do you think gold began to falter in 2011? I just told you. Because the baton was passed from gold in 2011 to its better, stronger, faster, safer, more secure digital brother, Bitcoin. From 2011, gold falters. Of course, it comes back, but it's faltering again right at the same area. Gold falters from 2011 while, check this out once again, while, what happens? While Bitcoin from 2011 soars, right? 480,000 percent. Never in the history of the world has a digital or digital version of an analog item stayed below the value of the analog item it has replaced. I'm going to repeat this. It's very important to understand this, guys. All right? Never before in the history of the entire world has a digital item that is replacing an analog item. Hear me out. Never before in the history of the world has the digital substitute stayed below the value of the analog item that it is replacing. So email didn't stay below the volume of physical mail. All right. Streaming music did not stay below the volume of CDs and vinyl records. Streaming videos did not stay below the volume of VHSs through Blockbuster. All right. Or movie theaters. The volume exploded exponentially. The volume of mail exploded. The volume of music exploded. The volume of movies exploded. Books that are digitized are in greater number than books in libraries today or books in physical stores. Amazon has digital shelves. Walmart has physical shelves. All right, some digital now because it's following Amazon. But for the most part, when Amazon came into existence, its edge was that it had digital shelves. The problem with Walmart, it had only physical shelves. So the volume of sales off of digital sales would never stay equal or below the volume of sales from products on physical shelves. This store can only hold 8,000 products. Amazon doesn't have an 8,000 product limit. It has an unlimited limit. In the past, companies that would try to get their products in a Walmart or in a Target or in a Sears, there were millions of products that those companies said, no, you're not good enough. But when Amazon came into existence with unlimited shelf space, why would it say no to anyone? So an entire grand digital opportunity for every product in the world was opened up by Amazon. So whatever is digital, digital shelves will greatly outvalue and outvolume the physical shelves. Digital movies will outvolume and outvalue physical movies. Okay? Digital streaming music will outvolume and outvalue physical vinyl records, cassette tapes, and CDs. Okay? Digital mail, email will outvolume and outvalue licking envelopes and putting stamps on the envelope and walking to your mailbox and mailing it. That'll never be bigger than the digital version. Now, let's move this reality that we know Let's move this fact to now Bitcoin is digital gold. Gold is $12 trillion asset. Bitcoin is $600 billion asset. You tell me if what we're saying is correct, that the digital version of something never stays under the value of the analog item that it's replacing, not only does it equal, but it goes exponentially higher than the analog item it is replacing. So if this is true, and we know it to be true, where is Bitcoin's true future value? Is it down or is it up? And if it's up, by how much? Up to 12 trillion? No. Did Amazon go up to the value of Walmart? No. Did Netflix go up to the value of Blockbuster? No. Did Spotify go up to the value of a recording studio or a record company? No. You understand? Did email go just up to the volume of physical mail? No. All of these things exponentially outstripped the analog version. Why? We live in a digital world. How do you give 8 billion people in the world gold? You can't. But how do you give 8 billion people in the world Bitcoin? That's my thesis, guys. You wanted me to talk about Bitcoin? It's the most asymmetric bet I've ever seen in my entire life. So if gold is 12 trillion, you have to make Bitcoin has to make 12 trillion small. Do you understand this? It can't just be 12. It can't go from 600 billion to 12 trillion. It's got to go way past 12 trillion. So what makes 12 trillion look small? 100 trillion? 150 trillion? You think I'm crazy. And I will tell you this. Mark my words. This is an asset that will go up for the rest of your life. Bitcoin, yes. Listen to me carefully. Bitcoin will go up for the rest of your living days. Not only the rest of your life, the rest of your children's life, and maybe the rest of their children's lives. Now, everybody or a lot of people say, Oliver, you're crazy. You've gone down this orange rabbit hole too deeply. You've lost your mind. Nothing goes up forever. Well, I didn't say forever. I said for the rest of your life, the rest of your children's lives, and maybe the rest of their children's lives. I don't know about, I'm not going to bet on anything after that, but I'm willing to bet 2-3 generations. Let me tell you this. Silver, 9,000 years. All right. It stopped going up about maybe 2,000 years ago. All right. Gold. Okay. Well, no, that's not really true. Well, yeah. Okay. It stopped really being a valid store of value about 2,000 years ago. Gold, 5,000 years. It's been going, gold is at its, is near its all-time high right now, which means that for 5,000 years it's been going up. Okay. The first bonds were like, what, 1,000 years ago? 600 years ago? But the official bond market is 300 plus years. Bond market's been going up for 300 years, traders. The equity market, equities have been in existence since the 1600s, but officially, let's talk about the equity markets in America. Under the buttonwood tree on Wall Street, 150 plus years, 150, 170 years, the equity market has been going up. We just came off of new highs a few months ago. So what does that mean? For freaking 150 to 160, 70 years, the equity market has been going up. It's had its up and downs in the middle. It's had its crashes in the middle, but it's always come back and has been going up for 150 plus years. All right. Microsoft has been going up for 50 years. It just came off of its all-time new high a few years ago. A few months ago. Apple's been going up for what, 48 years? Google's been going up for what, 25 years? No, Amazon's been going up for 25 years. Google's been going up for 23 years. Tesla's been going up for 16 years. Guys, look, Bitcoin's 13 years old. It's the baby of the bunch. It is the newcomer. It's that fast, vibrant, that young buck that you know is going to rule the world, you know? And so I've just never seen any opportunity like this in my entire career. And I can't tell you what to do. If you were to force me to say something, you had better get off of zero. If you've got zero Bitcoin today, I am telling you, I believe that you are going to be proven as being stupid. I'm sorry. I'm sorry. I felt this conviction with Amazon. I felt this conviction in 2001. I felt this conviction with Apple in 1997. I felt this conviction with Microsoft in 1994. I felt this conviction with gold in 2004, 2005. I felt this conviction with Facebook. I felt this conviction at $18. I felt this conviction with Nvidia at $9.50. My traders will tell you these are our plays. These are our mega wealth plays over the past several decades. But take all of that, put it together, shake it up and down, and multiply it times 100,000 times. And that's the Bitcoin opportunity. So if you were to force me to say something, get your ass off of zero. Now, I don't know what amount is right for you, but your amount should be incommensurate with your conviction. All right. And study the asset. Don't just do it as an investment. Study the asset. Start going down the rabbit hole. Start learning about it. Follow me here about it. Follow me on Twitter. My Twitter page is specifically Bitcoin only, nothing else. All right. Follow me there. I am telling you, I'm going to be able to say I told you so. I already can say I told you so from 3,800 when I first announced, let's do it. 3,800. All right. We're at 30,000 now. All right. And that's just the beginning. All right. So get off of zero. I don't know what amount is for you, but that, if you were to force me to say something, that would be it. Okay, guys, let's go to the next question here. All right. Whoa. Estella, I want to try to get this question right. Estella's asking, Oliver, hi, trading question. Can you explain the no continuation rule? All right. Can you explain the no continuation rule? You talked about that in one academy class in January of 2021. Let me see if I can demonstrate the no continuation rule. I think what Estella is talking about is this. I'm going to have to get some charts up here again. Okay. Let me get some charts up here again. Give me a second. And okay. Maybe I can use all right, let's see. Can I use here? No continuation rule. Before I can explain what the no continuation rule is, or the no continuation play, is I have to explain the statistics around certain types of events or bars. So, guys, strong bars, powerful bars, right? Like that. That's a powerful bar. This bar, especially depending upon the location, has an 80+% chance of producing more red. Okay. So this bar right there, that means 8 times out of every 10, a solid red bar will produce more red after it. See the more red after it? Boom. Okay. 80% of the time, not just little, but it has to be fairly solid. Okay. A solid red bar, the same way a solid green bar, 80% of the time will produce more green. Okay. Now, there are location specifics regarding this. So the 8 is from a good location. So this fat bar is a decent location. Let's see if I can get this moved over here a little bit more for you. So you see this fat bar? That fat bar is coming off of the 200. That's a decent location. It took a while, but it eventually went. This fat bar is what we call a clearing bar. That is a decent location. All right, so these solid bars have an 80% chance of follow through. But when they don't follow through, it is a sign often that the power that should follow through is going to happen on the other side. So, for instance, if this bar, you see this? Let's take a look at this. Now, you see that big bar right there, that last one I drew? All right. That's a series of down bars. If that bar doesn't produce another one, and at the same time, if you take out that bar's high, eliminating that bar, what should have happened on this side will happen on that side. Okay? So this is called the no follow through play. Solid bar, no follow through, take out the bar. Let me repeat that again. All right? Solid bar. Okay? Solid bar. Zero follow through. Take out the high of the bar, explosion in the opposite direction. Okay? So we can take a look at some of this here. So this was a powerful red bar. Okay? Remember, this bar was red all the way down to the low, right? But it experienced not a single extra tick below itself. All right, maybe it's easier if I draw this as a straight line. And maybe it's also easier if I open it up here. Let's do that. Let me show you this. So remember, this bar went straight down. Okay, this bar went straight down like that. Boom. That bar, that bar did not have a single tick lower. It produced zero follow through despite its power. Do you understand? So, despite its power, it had zero follow through. Let's put the zero right there. Zero follow through. It eventually got taken out by the market right here. So, this bar was now eliminated. And then look what happened. That's the no follow through event. What should happen to the downside doesn't, which means that now it's been flipped back on the other side to the upside. If we look at this solid bar, it may not look too solid for you right now, but this was a solid bar too. Take a look. Look at this solid bar. Solid, fat, red bar. How do we know it's fat? Look at the red bar before it. Look at this red bar. Look at that red bar. Look at that red bar. Look at that red bar. Even look at this red bar. Look at this red bar, right? You have to go back a long way to find a bar fatter than this one. So yes, that is a fat bar. It has zero follow through, right? Let's put the zero there. And the market eventually takes it out right there, basically eliminating the effects of this negative bar. And look what happened. Gotta love that sound. Gotta love that sound. So, traders who have a desire to be really good bottom pickers and top pickers in the market, right, guys? Those traders would be best to focus. There are several major turning events. One of them is the no follow through big bar turning event that I just explained to you. Okay. And I can show you, I think we looked at PFE. Let me just show you one more because I want to lock this in. I only showed you the red no follow through. Let me show you the green no follow through really fast here. Let me do that here. Give me a second here. I'll do that. Give me a second. Boom. So look at this fat green bar right here. Look at this fat green bar. Look. See that fat green bar? And this fat green bar. Now, this fat green bar did its job. It produced more green. The first one produced more green. All right? Now you get a second fat bar, which should produce more green too, but it doesn't. Not a single penny above that fat green bar was produced. Not a single extra penny of green. Zero. Now the fat red bar gets taken out right here. Basically, the fat green bar is taken out, basically eliminating or neutralizing the green. And while we had some temporary bounce, the rest is history. Okay, that's the no follow through event. Red bar, fat red bar here, not a single penny more, zero. The market takes out that bar here, neutralizing the negativity of that bar. It took a while, but that was the bottom. That was eventually the bottom. Okay, so this no follow through event is very, very powerful. It's very reliable. And those who have a desire to really become good bottom pickers and top pickers in the market, you have to become an expert at this no follow through event, along with several others. But this is one of the key ones. All right, so I hope that helps. All right. Oliver from Bona, Joseph. Oliver, how much should be our daily target percentage? And do we need to keep our maximum loss per day less than our daily target? Okay, good question. What should our target? I'm not. So this Bona is asking, first of all, what should a profit target be? And I'll have to tell you guys, I'm not a big believer in having a profit target. I'm a big believer in focusing on getting from point A to Z in your trade properly, and then repeating that and repeating that. What a target does, it has the potential to actually retard your progress. So what if you reach your target in one trade that lasts 4 minutes off the open? What do you do? Do you stop yourself from progressing if you're still in your developmental years? Do you not take any more trades until the following day because your target's been met? I think that's counterproductive if you are still developing. If you are already seasoned and you're just making a living and boom, you've got your $4,000 or $5,000, boom, I'm out, done, I'm going to the beach, that's fine. But this will hold back the developing trader by having that target. All right. Also, just because a target's hit doesn't mean you should exit. So this also gets in the way. Okay. That a plan should make you exit, not a dollar amount should make you exit. All right. I would have been out of Bitcoin a long time ago if a dollar amount made me exit. So, or even a specific percentage amount, like 100%. I bought Bitcoin at 3,800. I would have been out of Bitcoin below 8,000 and been happy for a 100% gain in a relatively short period of time. What if my target was 100%? I'd be kicking myself today. All right. So I don't like targets as much as I like just keep going, keep developing, keep trading, get from point A to point Z in each trade properly, then repeat. Now, with that being said, I do believe in raised trigger points. Let me explain to you what I mean. Every trader should have built into their trading plan a profit trigger point where it causes them to raise their maximum loss per day. So let's say, for instance, you start off with a $200 maximum loss per day. This is built into your plan. I will not lose more than $200 on any given day. Every trader needs that number. If you're operating with that number, you have zero hope. Zero. All right? Never. So you must, if you don't, you better get one now. Maximize, create a maximum for yourself. And yes, adhere to that maximum. Unplug the computer, leave your house, walk around the block, go to the mall, go to the beach, go to the park, whatever you have to do. Don't trade once you get near your maximum. Eliminate everything and leave. All right? You can come back and study later. Okay? So everyone needs this maximum loss, but that maximum loss per day can change throughout the day. As an example, now the trader that starts off today with a maximum loss of 200 has now made 300. That means that now you should have 300 should trigger a raise in your maximum loss per day. And that's going to be determined by how much you want to protect. How much of the $300 gain are you going to protect? Let's say you're going to protect half of the $300 gain. So once I hit, this is baked into your plan. Once I hit $300, I protect half of 300. So now half of 300 is 150. You've just moved your maximum loss per day from 200 to 150. No matter what happens, you're going to go home with 150. Let's say the next trigger point is 500. Okay? Now, from 500, you're going to protect 300. Now your maximum loss moved down from 150 to 200. So this maximum loss per day can fluctuate based on trigger points. That is better than capping yourself and saying, I'm done because I reached $400 or I reached $500. This is limiting, whereas that the other is not limiting. The sky's the limit as long as you don't commit the cardinal sin, which I hate and I despise. And I will tell you this. A trader's up $300 and they go home with negative 200. When you do that, you do not understand how hot my blood boils. To me, this is far worse than just losing 200 right off the bat. It is a greater sin to have and to be so irresponsible that you let it go, that you don't respect the gain. You don't respect the process. This gain means nothing to you. It means so little. You disrespect this gain, this process that got you the gain. You disrespect it so much. Not only are you willing to just trample over it and lose it all, you're willing to lose more, almost double. I have no words for a trader that ever allows themselves to do that. To me, that is not intelligent. To me, that is just a degenerate's mindset, and it ticks me off to no end. Do you understand? It ticks me off to no end. Do not do that. And so what this means is that every trader has to build inside of their plan these profit trigger points. 300, I protect half. 500, I protect 3/5. 600, I protect 400. 800, I protect 700. 900, I protect 800. 1,000, I protect 950. So I think it should actually, when you start to get into really high numbers, you should start shrinking it and being very strict with yourself. But you must build these things in your system. And you can't do these trigger points too soon. Like, I'm up $20, I'm going to protect myself $10. No, we can't do it that small. You understand? So you need some level. It's got to be 150 and above. It depends on your account, of course. But don't do it for little small change. That puts you in a straitjacket too, and that's asking yourself to just basically die by 1,000 cuts. So you don't want to do that either. But you know what I'm saying. And so instead of having a limiting target, have these profit breakpoints where you start protecting your gain, but keep trading. The reason this is very important that you keep trading is because your success, your mastery is on the other side of your experience, which means that you can't be successful and you can't be masterful before you have become experienced. So, any success that you have before you can consider yourself experienced, any so called mastery you think you have before you can say that you are legitimately experienced is really not skill, success, or mastery. That's luck. That's just mathematical numbers of flipping a coin. That has nothing to do with your ability right now. That can only be known after experience. And so when you have these profit targets that stop you from building your experience, you're slowing the day down where you arrive at full experience. Don't ever stop trading because any form of stopping retards the ultimate goal. All right, guys, I hope that helps. All right. All right, let's see. Mister's asking something. I'm not quite sure how I can answer this. When trading, do you look at ICT methodology? I'm not sure what that means. ICT methodology. Breakers, order blocks, fair value gaps, etc. So because I don't know what any of that stuff means, the answer is no, I don't, Mister. All right, look, guys, look. Stock, the stock, the 20-period moving average, the 200. That's it. I'm a price action guy. Sorry. I don't I don't try to make the process more fancy. I don't try to make my chart look like a bowl of spaghetti with this line and that line. You know, I like Italian, but I don't like my charts to be Italian. I don't like my charts Italian. Spaghetti, pasta, this line, that loop, this, that. Chart 2200, boom, price action. Because, in my opinion, when you're using indicators, these things seem like indicators, derivatives of the price. It takes you away from the very thing that makes you money or makes you lose money. You're either going to make money or lose money by the price. But so I'd rather focus on the thing that is going to make me money or make or lose me money. The very thing, the pure thing. I'm a purist. When you take my attention away from the thing and move it to something that reads the thing, I've now taken my eyes off of the thing. No, this reads the thing, but I've taken my eyes off of the thing that this is reading to the reader of the thing. That's a derivative of the real thing. That's a carbon copy of the real thing. And there are people who have the thing, but they'd rather focus on the indicator of the thing. And then they rather focus on the indicator of the indicator of the thing. And some people go way down the line. The indicator of 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 the thing. They're way off the deep end. They have left the real thing very far in their sights. And you can get lost here. Guys, I did this. I started off with the basics. I went all the way out on that crazy curve. I went so far that I was studying astrology as it relates to price movements and keeping statistics on certain planetary alignments and how they aligned with prior market crashes, prior market turns, to the downside, to the upside. Yes, I got that far away from the thing. The thing is staring me in my face right on my screen, and I'm up in the freaking stars, right? Studying astrological charts. That's how far away from the thing I got. And I had to make a complete loop all the way back to the freaking basics. The basics are simple, guys. There's two bars. There's two types of bars, green ones, red ones. Let's not overcomplicate these things. There's two basic, powerful moving averages, 20, 200. Let's not overcomplicate these things. There's two positions. The bars are above the 20 period, the above both moving averages, the bars are below both moving averages. Above and below. Two bars, red and green. Two moving averages, 2200. Two positions, above the moving averages, below the moving averages. Two directions, up, down. Two states, narrow, wide. Two actions, buy, sell. Two results, win, loss. Do you understand what I'm saying? If you can count to two, you can do this if you don't overcomplicate things. But if you start to overcomplicate things and going beyond 2 to 3 to 4 to 10 to 20, you're back to making your charts and your whole mindset mush like a freaking mushy bowl of spaghetti. And it does not work. The most powerful things in the market, as well as the most powerful things in life, your life too, are the simple things. The most special things in life are simple. They are not complex. They are not complicated. They are not convoluted. Do you understand? Keep it simple. And there's this tendency on the part of human beings to believe somehow, we've been conditioned to believe it can't just be that simple, but it is. It just can't be that basic, but it is. We think that if it's not complex, it must not work. And this is a form of ego, because there's a bunch of you who want it to be complex so that the vast majority can't understand the complexity so that you can look important. But anybody can understand red bars and green bars, above the moving averages and below, up and down, buy and sell, win and lose. Because that doesn't make you feel special. You don't like that. You understand? There's how many people, I'm going to look at it. How many people here right now? Let's see. I got how many people? This is freaking ridiculous. There's 385 people viewing this right now. That should be 38,000 people. Do you know why? Because it's red and green, up and down, above and below, buy and sell, win and lose. I keep it basic. Nobody wants basic. Nobody wants simple. They want complex. They want fancy. All right? Someone, what? Karen, what? You sending me money? Oh my God. What the heck is this? I don't know what that is. I don't know what 40. What is that? Karen's Sack Pal sent me 40 something. It doesn't look like dollars. It doesn't look like euros. It's probably like 2 cents of some other currency, but that's okay. I appreciate it all. All right. You know where that's going, right? Straight into Bitcoin. That's right. You know that. All right. Karen's Sack Pal is asking me, what's the difference between, you don't have to send me money for this stuff, guys, between simple moving average and exponential moving average? Well, it's a mathematical formula that supposedly makes the 20-period moving average basically front loaded. So think about this, Karen. The 20-period simple moving average is simply taking 20 data points from each bar. So if it's a daily chart, you're taking, let's say, the close of the last 20 bars, you're adding all of those values up, you're dividing by 20, and you get an evenly balanced 20-period moving average. So the 20-period simple moving average is balanced throughout the entire 20-bar data set. Now listen to me carefully. The exponential moving average is a mathematical formula that front loads the 20-period moving average. And so instead of the data points being considered equal, it places a heavier weighting on, let's say, the last 5. And so the front end of that 20-period moving average moves faster than the tail end. So in the simple moving average, all data points along the 20-period moving average are considered equal, right? They're equal throughout the whole 20. Every data point is equal. But when you place more importance on the last 5, the front part, Is that front part of yours? No, I think this is the front part. You looked at your way. The front part of the moving average reacts faster than the tail part. And so if the stock has been shooting up over the past 3 days, that 20-period moving average will flip up faster than the exponential will flip up faster than the regular 20 will flip up. So some people consider that better. There are things like the weighted moving average, which weights the middle. All right. So the weighted moving average plate says there's the beginning of the 20-period data set, there's the end of the 20-period data set, and then there's the middle. So typically a weighted moving average will not place the emphasis on the first part of the 20 or the last part. It'll put it in the middle and give it almost like this seesaw weighted or balance type of listen, let me just tell you this. I have experimented with every possible form of moving average you can think of. I've even created versions of my own moving averages. And guess what? I went all the way to the stars and back. I'm back. It's freaking simple. I keep it simple. If I have a choice of overcomplicating something or adding something sexier to it, I will opt for the basic. I will opt for the simple. And to be honest with you, when you look at a simple moving average and you overlay an exponential, the difference is so small that it really doesn't matter in the grand scheme of things anyway, because I'm always telling you that moving averages, while they appear to be skinny lines on your chart, they are far from being skinny lines. They're more like zones or boxing ropes. You know how the ropes of a boxing ring look small, but you can lean on them. They have leeway, right? So the same way your skinny line looks skinny, but it has leeway. So when you break the 20 by a little bit, you're really not breaking it. You're leaning against the ropes, right? But the ropes don't break. And a lot of people get this mixed up. They treat moving averages as if they're glass floors or ceilings and they break or shatter at the first point of contact. And that's not true. They are zones. Do you understand? They're ropes you can lean on. And I wish there were a way for charts to make moving averages rubbery, like a rubber band, but they can't. So I hope that's answered your questions. I don't know how much you sent me, Karan, but once again, thank you so much. I appreciate it. I'm very glad I saw that because there's a good chance that I missed that. All right. MF Hussein is saying, Oliver, please make us understand about the lagging nature of moving averages. Well, I mean, that should be basic enough to understand that a 20-period moving average is narrowing. All right. Thank you very much, Karan. I appreciate that. The 20-period moving average is averaging a 20-bar period. So the 20th bar ago is in the past. The 19th bar ago is in the past. The 18th bar ago is in the past. The 15th bar, the 10th bar, the 4th bar, the 5th bar, the second or third bar in the past. All of these are past. And so because the moving average is still incorporating the past, the present can outrun the moving average. So if the moving average is averaging the past 20 past bars and your current bar is running, the current bar can separate itself from its key moving average because the moving average has to keep calculating the past. Now, every time there's a new bar, the final bar, the 20th bar ago, becomes the 21st bar. It drops off. Every new bar starts to get incorporated and knocks off the last bar. But it will always be lagging. The only way a moving average can't be lagging is if it's just a 1-bar moving average. I've got a 1 moving average on my chart. That's the bar, my brother. You don't need a moving average for 1. That's the bar itself. Oliver, how does a one period moving average work? That's the bar. You don't need a moving average. Moving average is averaging multiple bars. So because of this, it's always going to lag price. And that actually is its beauty. Its beauty is in its lagging so that you don't get so caught up in the moment that you still have this step back, let me see the forest. Let me not get so wrapped up into one of the trees. I still see the 20, there's 20 trees in this forest. All right. It's going to take more than one tree to move the forest, to change the nature of the forest. All right. I hope that makes sense. All right. Well, damn. 449 of these now. I don't know what that is. This Indian rupees? Are you guys sending me Indian rupees? What are you doing? All right. Play with odds. All right, guys. Um, Ralph is asking me, Oliver, can you give us your current take on the Amazon chart? Would you take any position in this stock? Now, I have to tell you that to be totally transparent, I have been an owner of Amazon from 2001. I have bought and sold, but I have still have my original buy from 2001. And it hasn't been doing so well over the past year and a half or so. But over the past year or so, year and a half or so, but that's okay. Let me just show you this. Here is here's Amazon. Make sure, boom, once again. I don't know why it keeps doing that, but okay. Bring me back to Bitcoin. Yeah, I like it. All right, so here's my 2001 purchase, guys. All right, there we go. Split adjusted, but I'm coming in here. All right, that bottom there. Okay, and you can see like over the last year or so, it has kind of topped out. Now it hasn't done this in a while. It did this a little here with a slant to the downside for multiple years during the 2000s, but a lot of things were doing that. All right, and then after that, it's just kind of V peaks, right? Just like everything else, V peaks, but it goes flat here. So this has been a really interesting period for me. And I did during this flat period lighten up quite a bit. And I put it in Bitcoin during this period. So I came out of a good chunk of my Amazon and I put a lot of things. I came out of my gold. I came out of my Amazon. I came out of some of my Apple, came out of some of a lot of things and just socked it away in Bitcoin. But anyway, okay. So what's the overall take here? Still very positive. It's this you're looking at a monthly chart here, guys. It's still very positive. Basically, if this were to drop and severely break through multiple lows, rally and fail. Remember, that's that market law 4, right? I was telling you about. We haven't, in reality, had a market law 4. See, this is the market law 4 I was telling you about earlier. Rally, drop, failure to make a significant new high, and boom, that's the market law 4. You see? After making, remember I told you that it's after a series of new highs, new high, new high, new high, failure to make a new high here, and market law 4, and we crash. There's an Amazon crash, just like everyone says, Bitcoin's crashing. Yeah, no, it's crashing upward basically. What do I do here? All right, so we don't have a market law 4, but we do have a rounded top, which I'm not overly happy about. But if we were to do something like that and then fail hard here, you can technically, based on my work, you could expect a multi-year setback for Amazon. How long? I mean, this was a multi-year setback here in the stock. All right. And this too, in reality, not as quite as long, but remember, these are months, guys. All right. So we don't have a 4 yet. I want to see how Amazon handles its next move up. But guys, let me just say this before I go, and I will have to go. I want to say this though. All right. Let me say this. Amazon's been going up for over 20 years. Do you understand? Bitcoin's been going up for 13 years. Well, 11 years, really. Let's call it 10 years because its price started at the end of 2011. So 2012 is really 10 years. So Amazon's been going up for 25 years, 20, 25 years, right? Apple, powerhouse. I own it from 1997. That's been going up for 48 years. Microsoft, I own it from $18, but also from 1994. But I put my traders in it at $18 much later. That's been going up for 50 years. So just like a short-term oriented play that's up 7, 8, 9 bars in a row, what do you think? Where do you think we are before there's some serious problem? Are we at the beginning of the move before there's serious problem? After 48 years, after 50 years, after 24 years, are we just starting so a major problem is a long way? No. All right. Are we halfway there? So when you look at that Amazon chart, are we halfway before there's a serious problem? Probably not. We're closer to the end before there's some serious problem, right? But Bitcoin is at the beginning. So I say that just to be cautious that you can start to play the darlings in a big way too late. Like guys, there's no one in the world right now. There's no one in the entire world that doesn't know Amazon was a huge successful investment. What does that tell you? Bitcoin, there's 1.5% of the world believes it. 1.5% believe it. And it's up 480,000% with only 1.5% of the world in it. So think of this. Everyone in the world knows Amazon's good. 1.5% of the world knows Bitcoin's good. Everyone in the world knows Apple's a good investment. 1.5% of the world knows Bitcoin's a good investment. You have to be careful about becoming overly excited about something after the entire world knows. Do you understand? So I leave you with that thought. You know, I'm not saying that there can't be some decent opportunity still in an Apple, in a Microsoft, in an Amazon, but it's so much the obvious play now that I would not be focused there in the biggest way. I'd be focused in what's has the potential to be the next thing that is not quite as discovered already. Tell me you understand this. I'm not going to leave until I see your comments. Tell me you understand this. Tell me this makes sense. All right? Make sense? Yes? Yes? The best adult dating site. What are you doing here? These bots are crazy, guys. These bots are crazy. All right. Um, all right, cool. Yes, awesome. Good, good. Quick question here. I think is important. Um, Oliver, when looking at 48 years of history, shouldn't we consider adjusting the purchasing power of the dollar? This might change the chart by a whole lot. Well, no. In a way, yes, but no. In a way, you don't have to adjust the purchasing power because the rising Apple, the rising Microsoft, the rising Amazon is a direct reflection of the devaluation of the US dollar. So if you were to price, so when you're looking at a Microsoft chart go straight up, it's that's looking at the dollar going straight down. It's rising against the US dollar. Do you understand? And some people don't know how to separate the actual rise from just the debasement or the decline in the purchasing power of the US dollar. Do you understand? So this is so in a way, the devaluation of the purchasing power of the US dollar is why, in part, that assets like stocks are going up. Because in order to escape a sinking dollar, you get dollars and switch them where? To the stock market. Or you get dollars, melting ice cube, before it all melts, you switch it into something that's not melting as fast. Real estate. You get dollars, starts melting right away. Before it totally melts, you switch it into something that's not melting as fast. Bitcoin, gold, real estate, stocks, used to be bonds, not anymore. Do you understand? And so the very declining of the purchasing power of the dollar is what causes the switch from the dollar to these other things. That switch causes their prices to go up. So you're looking at the debasement of the US dollar when you see a rising Apple, a rising Amazon, a rising Microsoft. You're basically looking at the dollar chart in reverse. When you look at a chart of real estate prices going up, you're looking at the opposite chart of the dollar going down in purchasing power. All right. So we all know that the dollar's lost 98% of its purchasing power since 2000, I mean, since 1913, the very year that the Federal Reserve came into existence. And quite interestingly, the birth of the US Federal Reserve Bank is the exact death of JP Morgan. How interesting is that? I studied JP Morgan, guys. I went down the deep rabbit hole with JP Morgan because he was so much of a financier and so much at the founding at the foundation of America's start as being an industrial power. And in essence, JP Morgan was the central bank and controlled virtually everything. And when he died, the same year he died, the Federal Reserve Bank came into existence. So what happened? The control that JP Morgan had was basically, I guess, these five entities felt like there's too much control centered into this one guy. Let's just break it up amongst five of us. All right. And these five powerful people, entities, got together to form the Federal Reserve. supposedly separate from the US. So there's nothing federal about the Federal Reserve. Okay. And there's nothing central about the central bank. It's not central at all, not centralized at all. And so that's really interesting. But it's interesting to note that the debasement of the US dollar began to accelerate from the year 1913, the very year the official Federal Reserve Bank came into existence. And you can look at the chart, it topped out in 1913, and it's been going down ever since. And so if you think, when you look at a Bitcoin chart that's going up like this and a dollar chart that's going down like this, if you believe the lie that it's safer to sock away in the dollar than it is Bitcoin, then I'm sorry, I don't even know how to help you because it's in your face. The Bitcoin chart is like this. The dollar chart is like that. And you think it's safer to go in the chart like that? I can't help you then. All right, guys. I love you to death. Last question. I promise it's got to be my last question. It's from Martin here. Only because it's a question very close to my heart right now. Oliver, please give your opinion on converting ETH to Bitcoin now when prices are low so we don't pay so much taxes. First of all, I can't tell you what to do, but I will say this in general. I don't think it's ever wrong. I don't think you can ever be wrong switching something that you have that's not Bitcoin into Bitcoin. Ethereum is not Bitcoin. Switching that into Bitcoin can never be wrong. In my opinion, this is my opinion. Switching a stock that you have into Bitcoin can never be wrong. Never. Not if you have a long enough time preference. Not if you've got 4 years plus. You can't be wrong. And so I would say do it whenever you want to. You can't be wrong. If you think the right time is now, you can't be wrong. But because I believe that over time, Bitcoin makes everything go to zero. That is its history. That is what it has done. And that's what it will continue to do. It will continue to make the charts of everything else go down because it will go up exponentially in relationship to the thing you're measuring with. All right. And so ultimately, if I can show you this chart real fast, here is let me show you this here. Here is the chart of Ethereum. Why am I doing this here? Let me show you the chart of Ethereum here. Get you this chart here. Here's the chart of Ethereum in US dollars terms. So you see that? Look at how beautiful. What does this chart based in the US dollar suggest? That Ethereum it's safer to hold Ethereum than it is to hold the US dollar. Right? Because it's priced in the dollar. Do you see? So if you were to flip this around, US dollar Ethereum, the dollar chart priced in Ethereum would look like this. Right? So it's clear that over time, it's safer to hold Ethereum than it is to hold the dollar, at least based on this relatively brief history here. But that's an impressive chart right there. But if you price Ethereum in Bitcoin, you get a different picture. If you use Bitcoin as the denominator, what you see here is that after the hoopla, after its creation, in one cycle, after one cycle, it never makes a new high. All of these altcoins basically make a move in the first cycle and they never realize their glory on any subsequent cycle against Bitcoin. People get caught up in their initial run-ups right? But they never, not everyone, but 99% of them never see their glorious highs against Bitcoin again. You understand? And so you must get in the habit of pricing everything in Bitcoin. Like look at the S&P. Here's the S&P 500. That is a beautiful chart, but it is priced in dollars, which is a weak denominator. So if you compare this against the weak denominator, this looks powerful. But if you were to price this in a strong denominator like Bitcoin, this is what you get. That same S&P priced in Bitcoin, all right? SPYBTC. Look at the chart. It's the other way. I can't even. It's so look at the high. It's basically waffling flat over the past year or so, but it never sees the glory again. Do you understand? So this chart against the dollar looked very different from this. But in priced in Bitcoin, Bitcoin's winning. So this shows you it's safer to keep your money in Bitcoin than in the stock market. It's showing it's safer to keep your money in Bitcoin than the US dollar. It's showing you it's safer to keep your money in Bitcoin than in Ethereum. Start pricing everything in Bitcoin. Put the symbol and then Bitcoin afterwards, right? And then you'll see. All right? You'll see what's better, what's safer, what's former. Don't let the rhetoric on television dictate these things for you. You've got the facts in front of yourselves, okay? Guys, look, love you to death. You are amazing. I want to thank each and every one of you for continuing to show up to my live sessions. I do want to let you know that I'm going to start increasing the number of lives I do on a weekly basis gradually. So the very next live segment I will be adding to the weekly roster is a technical analysis day. So I'm slated to do that on Thursdays. I'll let you know when I start. So we're going to have Q&A days on Monday, typically, makeup day on Wednesday, right? So typically Q&A live session like this Mondays. Technical analysis day on Thursdays, where I take a technical concept and we do a deep dive live in that technical concept. And I promise you, if you string these Thursdays together, you're going to be happy. All right? That's my promise to you. All right? So you spring these Thursdays together, link them together, build upon them, build upon them. You're going to build your technical expertise, your technical knowledge as it relates to the market, I believe, in a very, very substantial way. Then I am going to come out after we do that for a while. I'm going to start back with my midnight talk session. So this segment's going to be called The Midnight Trader. And so it's going to be midnight in my time. So it might be morning in your time or some other time, afternoon or whatever, but it's going to be midnight my time. And so this segment's going to be called The Midnight Trader. And we're just going to basically get on live and just banter and talk about anything. And what I'll typically do is I'll do a little monologue at the beginning of that, probably on something that's current and relative to our world right now in trading in the markets. And then, boom, we just go from there. It's going to be sort of like a freestyle, grab a glass of wine or drink or whatever, or beverage of your choice. Let's sit back and let's just powwow like we're around a table, just bantering back in front of each other. I used to do this on Periscope. Many of you remember the Periscope Lives. I have had this growing chorus of individuals that want me to bring that back. And I've listened to them, I've heard them, and I'm going to do it. I'm bringing back the Midnight Trader. So that's going to come after I get settled with the Thursday live sessions on Technical Analysis Day, okay? All right, so guys, look, I love you to death. Thank you very much for being here. Continue to do this. If you haven't already, please hit the like button on this video. I want you to subscribe to the channel. All right. Make sure you click the bell in the upper right hand corner. Turn all notifications on so that you don't miss a single piece of content. Right. I put a lot of time into these channels, making sure that every single day you take an additional step toward that ultimate goal we call trading mastery. All right. Love you to death, guys. All right. Ciao for now. Boom, boom, boom. Peace.